Hey everyone, welcome back to the Brewing Money podcast. I'm here with Kieran. Actually, today we wanted to talk about a topic that's actually brought up pretty often. I think a lot of people really want to understand like what it would take for a first-time home buyer to really get into, getting into their own home.
Yeah. And so if you guys are listening, you feel overwhelmed, a lot of times it is overwhelming. I think we're in the industry, so we feel like it's common sense.
Oh, yeah.
But there's a lot of first-time home buyers, young people that are just starting out, and it can feel overwhelming. So we're just kind of going to talk in layman terms. Where do you start, right? Where do you start? Absolutely. What would you say, Gunwar, is the very first step whenever you're looking for a home?
So honestly, I think one thing that a lot of people seem to kind of like gloss over, but I personally think it's like the most important piece of it, is getting pre-approved. A lot of people don't understand that like when you are searching for a home, you could look wherever you want, right? You can find like a, X home at like $1 million, and then you can find, Y home at like 200,000. But the case and point I'm trying to make is mainly that if you're just going shopping without understanding how much you can qualify for, you're kind of just like throwing a shot in the dark, right? Like it doesn't really help you on that. And I think like in order for anyone really that wants to be smart about it,
yes,
they really should at least just look to the loan process first, look to getting pre-approved. That way, when you do go shopping, you know how much your budget is, you know how much you can afford.
Yep.
And they'll at least be able to tell you like, what you can kind of like look forward to, how much down payment, etc. Just those kind of things, right?
And more than anything, you know what it is? And this is the most common mistake, across the board. We get excited and in our mind, and a lot of people, it's either to one extent or the other. Is like, I can't afford anything, and some think, oh no, I'm not going to have a problem, qualifying for a loan. So they want to go out there and start looking at homes. And what you're going to find is you may say, oh, you know what, I want a house in the $500,000 range, $400,000 range. And whenever you actually start to go look, you're like, heck no, I don't want to live in a place like this, right? Or this is way too big, or, this is too small. You are going to learn. You don't, most people, they think they know what they want. I think that before you may have this idea of what you want, but whenever you start to look, it usually changes how we start with a buyer and how we end with a buyer. Almost got like 90% of the time, it's going to change. Your price is going to change. The square footage is going to change. The type of home, the neighborhood, whether you're okay paying HOA, whether you're not, because you can tell differences in neighborhoods, right? So first reason you should get qualified is because you're going to waste your time. You may think that you can qualify for a $500,000 home, and you may find that you can't. So you're wasting your time, and you're wasting the realtor's time. So absolutely, I think where you need to start is look at your financials, look at what you're paying for rent to say, okay, this is about what we're paying. This is about what we can afford. Now let us look at where do we stand? Is it, what do we need to look at? Credit, down payment, what do we need, right? So absolutely getting pre-qualified, and I think now most realtors, I know with us, I won't take a buyer out.
Yeah.
I just won't. I'm not doing you justice. I'm not doing myself any justice, right?
No, that makes sense. Yeah. And I mean, like, realistically, like, why would you really want to go out there without knowing how much you can actually afford, right?
Right.
And then I think like another
and gas is expensive.
It is. It really is, especially right now.
Yeah, gas is expensive.
Yeah, and then even going back to that, I mean, a lot of other costs too that'll get associated with like purchasing a home. People don't really understand that either, right? Like they kind of just assume like, okay, we have the mortgage payment, maybe, they'll understand like taxes and insurance, but like that's just like a very basic, cost that you'll essentially incur whenever you do get like a loan, right? But like there's so many other costs that you really have to think about. And this is always something that I like to stress, at least to like anyone that works with me, right? Is that like, okay, you might have this that's showing on the loan application, but like let's talk about like, PG&E, gas, heating, lighting, furniture
Yes.
costs,
Yes.
any sort of like, as you said, like HOA costs,
Yep.
maintenance, stuff like that. You want to make sure like anything that you have on the property is like in good condition. You don't want to go into something that just looks like, somebody, they didn't really care at all. They just kind of
Yeah.
like
Yeah.
threw
Uh-huh.
trash everywhere. They just like let it all mold and rot.
Mm-hmm.
And so like these kinds of like costs, like and there's plenty of more, but these are another like you could almost call, I wouldn't want to call them hidden costs, but they're like costs that you really wouldn't think about
Yeah.
until after it happens.
Yes. It's because, so here's how it works. Okay. The process works whenever you're going to get a loan. Just because a lender qualifies you for a certain amount does not mean that is what's going to be comfortable for you. So how lenders qualify, we look at something called PITI. You're going to look at your principal, interest, taxes, insurance, your solar bill, if you have HOA, and they're going to just account for that. Now they're going to take that and they're going to compare it to what you earn, and there's a percentage, right? And along with that, they're going to look at your credit report. And on your credit report, they're not looking at your total balances. They're going to look at the minimum payments that you make. So what's not on that credit report? All the stuff that Gunwar mentioned, right? Your PG&E isn't on there. Your utilities aren't on there. Your groceries are not on there. Your gas is not on there. Your insurance, furnishings.
Yeah.
So much is not on there, so that you can't go by just what the lender says. Hey, we're going to qualify you. You can afford $5,000 a month for a payment. That is, I think, the biggest thing where you guys really need to step back to say 5,000 plus all of this other stuff, and you have to be comfortable with, can we afford that every
Yeah.
single month, right?
And I mean, they do it based off of like your gross income too. That's before
Yeah.
taxes.
Yes.
So,
Yep.
obviously people really need to understand too that like, just because your income before taxes is a lot higher, obviously you can only spend what your take home is, right?
Right.
Like that kind of stuff
Yeah.
doesn't really
Yep.
get like
Yeah,
talked
and
about.
it's exciting. I get it. It's so
Yeah.
exciting to say, "Oh my God, I can afford a $800,000
Mm-hmm.
mortgage," and any lender is going to be like, "Hey, the bigger the loan amount,
Yeah.
the better for me."
Exactly.
But here, and I think a lot of lenders, there's a lot of good realtors and lenders out there that want to not just do a transaction. We want to build a relationship with you. We want to look out for you. We want you to invest in the future. And, if you're not going to do well with a house and you're going to be stressed, right, we're going to have given you a bad experience as well. So we don't want that. So what are some of the myths, do you think, when it comes to, we've already discussed where it's not hidden costs, but, don't go for whatever the lender approves you for. See what's, feasible for you. But what other myths do you think are out there when it comes to getting a loan for your house?
So one myth that I think it's pretty commonly thought of is about the down payment requirements. A lot of people assume that you can only really qualify if you have 20% down on a home. And while, I mean, it's optimal, right? Like obviously the more that you can kind of cut off of the loan, the better for you, right? Because then you don't have to pay that extra interest or whatever.
Right.
But that doesn't necessarily mean that that's a requirement.
Right.
I know like for our regular like conventional, which is like I'd say it's probably like a standard kind of like loan for most people.
Yeah, conventional, I would say, is the good buyer.
Yeah.
If you want to put buyers,
Yeah.
the high good scores, good
just
income.
like average, you could say,
Yeah.
right? Like I'd say like even just throwing a number like 680
80,
plus or something on a
yes.
FICO, right? But like, the minimum requirement from what I've seen, at least on the conventional loans, they're 3%.
Yeah.
A lot of people, assume that, okay, well, like I need to bring in so much money, but you can go in with as little as 3%,
Yep.
right? And one thing also though to note though, even though you can go in with that amount as well, there is usually like another not hidden cost, but another cost that comes associated with that, the less down that you have.
Right.
And that's, what is it?
PMI.
PMI, yeah.
PMI.
And I mean,
Yep. So PMI also, so that's one, sometimes we see, clients come in where they could have gotten a conventional opposed to an FHA, and someone put them in FHA. So when it comes to the difference between conventional and FHA, without getting too much into it, is conventional is it's a cheaper loan overall, okay? But if you do not have the good credit and higher income, and good credit 680, it doesn't have to be crazy, but the guidelines are a little bit more stricter. But conventional is the cheapest, right? But if you need to get your foot in the door, right, and you've been renting and you can afford it, but and you're paying off someone else's mortgage and you can afford to get your foot in the door and pay off your own property, FHA is a good way to get your foot in the door. But FHA, overall, it is more expensive. So there is something called upfront mortgage insurance when it comes to FHA. What that is a fee because it's higher risk, right? They're going to give you, if your score is not that great and your debt to income is a little bit higher, that FHA loan, they're going to kind of protect themselves. They're going to charge you that upfront mortgage insurance. They're going to put it right into your loan. And also, like Anwar mentioned, PMI. If you put less than 10% down, they're going to PMI you're going to get if you're paying less than 20% down for your house. But if it's less than 10% with an FHA, it's I think it's like 11 years you have to pay it, and usually you won't keep a loan that long, right?
Yeah, I think the 11-year mark too. It's just like if you're just constantly paying that minimum itself too.
Yeah.
But I do know the amount too is actually a lot higher as well because they do calculate that. I don't know the exact figure of like how they do that, but I do know that whenever it's less than 10%, that PMI actually increases a lot more.
Sorry. So less than 10% is going to be for the life of the loan. You can't get rid of PMI. And more than 10%, and less than 20 is 11 years. So I kind of said it the opposite way. So FHA, though, great product, right? A lot of people get FHA loans. If you had, you just cleaned up your credit, you don't have a whole lot to put down. Although conventional is 3% down, it's less. But, you're not that optimal. You don't fit into that optimal box. FHA is a great product.
Yeah. And I mean, I think their down payment requirement is not that much different either. It's like 3.5%.
Yeah.
I mean, that's their minimum, but I mean, it's really great just for those that are just kind of like, you could say like, their credit is kind of challenged, right?
Yes. Yep.
I mean, that's just kind of like where you'd want to take them.
Yeah. DPAs, there's down payment assistance programs.
Yeah.
This is what, if there's anything, and I don't know, this may sound a little bit like, esoteric or whatever, but I truly believe that if you once you decide that, I am going to get a house, you'd be surprised. We've had individuals come in where they thought for years they couldn't qualify. Everybody turned them down. But if you start working with a right lender and you do it early on, there's a lot we can do. There's so many different ways of getting into that home. And, I know we're a little biased because we're in real estate investing, but I always say real estate is one of the best investments. So if you can, just put your foot forward and just at least see, you owe it to yourself. Look at your credit. We've got credit repair, partnerships. We've started, worked with people for years where they started off really low and we helped them get a home and clean up their credit. So down payment, there's different options that you can, come up with. So there's always a way. That saying, where there's a will, there's a way. Okay?
Oh, of course. Yeah. And one thing you actually just mentioned, how you just said that you had we've had like past clients that have been working for years on their credit. Another thing I think like people also just kind of assume is that they need to start doing it like as soon as they're ready to buy the house, right? I don't really feel like that's necessarily true. I do think it's actually a lot better that you prepare yourself ahead of time. And even if you were thinking about buying like maybe like a year or two or in the future, right? I still think it's
6
much better,
months
right?
Even.
It's much better, I would say. Just from my own experience, to just actually go to the lender, right? Because not only are you going to be at least just aware of like what you'll need, but they can at least just prepare you too, right? Like, just for what you're going to expect. It allows you more time, right? Just to save up or whatever you want to do for that, or at least just kind of like predict like, how you're going to be kind of like moving around that. So
Yeah,
that's another thing. Yeah.
educating yourself. Seriously,
Yeah.
it's yeah. The sooner you start with it, and don't give up.
Mm.
I love whenever the clients are like, we got denied so many times and they did not give up. Don't give up. Don't worry. Over time, it's just about fixing, things here and there, getting funds together, and there's different ways of getting those funds together as well. And so,
Yeah.
yeah.
Yeah, and I mean, at least like that way too, right? Like you can actually see, like, even if you get denied, that doesn't necessarily mean it's over, like you said, right?
Yeah,
Like you can
yeah.
at least just see, like, what was it that they denied you for, right? Like you can at least go back. You can kind of like make that adjustment, either see like, okay, well, maybe we need this type of product, or maybe we, fit into this type of product
Yep.
instead, right?
Yep.
So I think like, as soon as, you pretty much get that denial, I really don't feel like a lot of people should back out. I don't think anyone really should back out. If you
No.
really are
Yeah.
determined to getting that house, finding your own home, then you really should stick through the process. And it's really just like for yourself at the end of the day, because as you said, real estate investing, it is, I would say, one of the most solid like ways to invest. It's very consistent. It's
Right.
I don't really feel like you've seen too many people that have kind of faltered in that.
No, I that is why we do what we do, because we really believe in it. And another thing is, how many times have we had a client when they first came, because the rate, and we work with wholesale lenders, by the way. So sometimes the lender, all of a sudden in 1 month, will say, hey, you know what, we're going to give you X amount of credits and a special deal, where we had somebody sitting in the system that didn't qualify before because we had to give them a higher rate because we can afford to buy it down. Now all of a sudden the lender's like, you know what, we'll pay for that buy down, and that's all they need. We've had people where they were just like $80 difference, right, in order to qualify. So don't give up. Get in the system, start working with a lender, stay with them, and start educating yourself, and you'll start feeling more confident, as you're in the process, right? So yeah. So what do lenders look at when they, there's 4 things that lenders look at when it comes to qualifying somebody for a loan. And
Yeah, so like I would say, the main things to look out for is going to be your credit, your income, your assets, and how much debt you have.
Yep.
And by debt, I mean that typically is just going to be any sort of like credits or credit cards, some sort of like open line, car payments, stuff that you would really see like on a credit report, not necessarily, like, oh, I don't know, like if you already own a home, right? Like they're not going to necessarily look at your PG&E bill or your water bill or any of those kinds of costs, right? Like that's like one thing you don't really have to use, but that's kind of like where they look really, is like your credit, your income, assets, and your debt. And like when they do focus on all this stuff, I wouldn't necessarily say it's going to be like a tier of like which one is like the most kind of important versus the least. It all really just kind of like, you could say, is like one kind of like qualification, because like, for example, like for your credit, right? I mean, that's one thing that people don't really, pay attention sometimes to, with that, how much it can actually impact your rate.
Yes.
And that actually will just drive up the other costs too. Like, like you could be at like a 740 or 780. I think most lenders usually consider as like the top like level, and then you could be at that level and you'll have like some great different, or some great rate, and when you go down like maybe like 20 points each time, it doesn't differentiate that much until you hit one threshold. It varies from like lender to lender, but like let's just say like if you hit like the 640 mark, anything below that, you can notice there's a very big difference on the rates on that, and that's another cost that is just really going to go towards you,
and it can make you or break you too.
Yeah, it can.
So how I think of first of all, I remember it as ACID. Okay, so assets, credit, income, and debt, right? And then I think the best analogy I saw of how all 4 of these kind of play together. Think of a table, okay, with 4 legs. if one leg is weaker, the other ones are going to have to compensate, right? So just like you were saying is that let's say, you had a credit of 740, and your payment was coming out to, $4,000. Now, all of a sudden, that your credit score lowered, your interest rate went up, and that 4,000 all of a sudden became $4,100. Now they're going to take, before at the 4,000 you would have qualified because you were making enough money, and it was a certain percent of what you were earning. And now, because your credit score dropped 20 points, your rate's going to be higher. Now your payments 4,100, and now all of a sudden they're going to say, wait a minute, you don't make enough.
Yeah.
So you see how the credit affected the income, right? And assets. Another thing is sometimes lenders will look at certain things, but if you've got a bunch of money sitting in your account, which is called reserves, and they know, hey, if Gunnar ever got into trouble with his payment, he's got 50 grand sitting in his bank account, he can afford to have something for a rainy day, right? Then so all of the four legs kind of play a part in it, and the stronger each one is, the better. And so the ideal loan would be all four of them strong, but that doesn't necessarily mean that that you can't qualify. You can have compensating factors like that.
Yeah,
right?
of course. And I mean, like, just like for another example, like when you're saying assets too, like, that could be another way to even just compensate, like how you were saying, like the cost of like the home went up to $4,100 a month. I mean, at that point you could still kind of like fix that, right? Like with the assets, you can pay it down more.
Yeah.
Or you can even pay down your interest rate actually as well. That's like an option.
Yep.
But I mean, no, you did give a great analogy. The four legs. I think I've actually heard that one before.
I heard that, and I liked it. I'm like, yep, that's exactly
it makes
how
sense
it is.
too, right?
Yeah.
Like you do want to make sure that like every one of those pieces is just really like stable, or at least just like optimal, because you don't want to, just because you can qualify for something doesn't necessarily mean that like it's going to be great for you, because like you could just be meeting it, but the moment one shift happens, it's not going to be good for you. So that's like another thing. But I mean, that's just something to really just like think about too.
Yep. So what do you think? What are some of the mistakes that first-time home buyers, what should they avoid? And this one is a simple one. You think it's simple, but man, how many times has it happened, right?
I can't even I can't even remember how many times I had to I really had to sit down some previous clients about this, and it's funny because like no matter how much sometimes like you kind of emphasize it to them, they still somehow find a way to just ignore whatever you just said. And one of the things that like I've really seen and encountered a lot was anyone really just opening a new line of credit, especially during the process.
It's going to show up.
Like I've had it. It's like where I think I saw a client, like it wasn't mine. I think it was it might have been Minraj's. I remember I was helping him on this one. He had somebody that actually bought a brand new Mercedes. And they were about 3 days out from closing. And the thing is, thankfully, they were still able to close it. But the what happened was like they found out last minute. And Minraj actually, he didn't even find out through the client. He just found out through the lender. So
ouch. Those are the ouches.
Those are one of the things. But the thing is like, even if you do decide to do something like that, it's so much better to let your loan officer, your lender know.
We're on your side.
Yeah, exactly. Because if you just tell us this, if you don't tell us these things, if you don't tell us how we can help you, or like what to expect, then like I don't know that you can't really just expect everything to go smoothly, because if we have to find out from the other party, which is the bank, usually they're pretty critical on a lot of this stuff. It makes it tougher for us, and then it makes it tougher even for you, because we really just try to make sure that we're like, we're a team at the end of the day.
Yes. So the mistakes we don't want you to make, okay? Don't apply for credit cards. Don't go buy a car. Don't sign for anybody. Don't change jobs, okay? Don't change jobs all of a sudden. What else? Oh, deposits. I think
Oh,
this
yeah.
is what, boy, I actually had a client. So when we move money around, especially if you say, hey, I'm going to give X amount, my down payment is $50,000. It's going to come out of my Wells Fargo account or Bank of America or whatever. And we show them that. And then they're going to look. They're going to look at your big deposits that came in. They're going to trace those. And we have had clients that have done like 13 different, where I think the underwriter even went a little bit crazy,
Oh,
where don't move money around. If you can avoid that, keep your money, especially where your down payment's going to come from, keep it in one account and try not to do large deposits. Usually rule of thumb is if I make $10,000 a month, any deposit more than 50% of my income, so anything over 5,000 usually, they can ask, hey, tell us where that came from.
yeah.
Tell us where that came. And we have had where we had so many bank statements, okay, where they have to trace it back and they'll keep tracing. So if you give them an account saying, hey, I did, if you've got an account and in that account I had a deposit of $10,000, they're going to say, okay, show us where that came from. They're going to look at that bank statement. Now, if that bank statement shows another $10,000 deposit, they're going to say, hey, show us 2 months of that bank statement. And you see how it can just keep going on. And some people, I don't know, they'll move money, they'll move it back. And they don't care. If you move it, they're going to want to see it. They're going to want to source it. So
Yeah, they don't like that's a lot of thing, or another thing I think people just don't really understand, which is fine, right? But you just really want to just make sure that at the end of the day you don't want it to look shady. Right? Because like when you do move your money around that much, I mean, a lender is always just kind of like looking just to make sure like their money is not going to be at risk at the end of the day, right?
Yep.
Like that's what they're assessing.
Yep.
And so if you're doing kind of like stuff like that, you might be doing it with good intent. It's not like anything like you might think of that's just odd, but it's just like when you think of it from the lender's perspective, you really have to understand that like moving it around from like 40 different accounts is just going to look weird. Like it's like, okay, I don't know, are you money laundering or something, right?
Yeah.
And I know like even cash too, right? Like
Cash
cash is a
deposits.
really big one. I know I've seen it plenty of times, and I mean, if you want to carry cash, that's fine.
Yeah.
But you really have to understand too that like that's not really something that you can trace, right?
Right.
Like so, you might have like a 50K laying around in cash or something, and then you decide to put it in your bank. How does the bank know that you're not like some big time drug dealer or something, right?
Yeah. But just like you said, it's risk.
Yeah.
The underwriter's job is to protect the bank, comb through everything, and make sure that they do their due diligence. And you're going to get annoyed. I'm going to tell you, if you guys are moving money around so much, and that loan officer is going to keep asking you, can you give me this bank statement and this bank statement? And you're going to get annoyed. It's not fun for anybody. Okay, no one involved. So yeah, those are some of the things that you should avoid. We kind of touched up on this, but if you guys have any questions, feel free anytime to ask us. And I know the second part is, yes, this is a loan piece of it, but there's also a real estate piece that goes. And when you start to go look at property, what do you look at? How do you make good deals? So we'll cover that in the next podcast, but make sure you guys continue to follow, like, ask questions and comment, and connect with us if we can provide any guidance.
Yeah, and make sure to like and subscribe, and thank you guys for joining us.
Yeah.
I hope to see you guys again.
All right.